Welcome back friends, welcome to the channel Jaiib and CIB made simple. So this is our unit number 38 10-minute miracle series. Already I have provided you 5 to 6 lectures separately covering each and every unit. In the next 10 minutes we are going to revise our venture capital topic completely and all the important points will be shared with you. So just give your valuable 10 minutes and you will be able to revise all the important concepts of venture capital. So let's begin with. So first of all, let's talk about the early days of the venture capital, right? So back in the 1970, India started setting up venture capital to help businesses with big growth potential. You can see written here. Now the first fund was the Risk Capital Foundation. Risk Capital Foundation, in short it is called RCF, and it was launched by IFCI in 1975. Then in 1976 IDBI launched the seed capital scheme, right? And aiming to support new business. It was aimed to support new business. Then after in 1983 government made a technology policy statement. This was all about making India more self-reliant in technology by encouraging the commercialization of tech. In 1986 ICICI Venture Capital Limited, ICICI came up with the venture capital scheme to back private tech expert in high-tech field. Around the same time, PACT program was started with 10 million US dollar grant from USA to boost tech commercialization. IDBI also launched its own venture capital fund in 1986, funded by the central government. And TDICI in 1988 took over ICICI venture capital operation, pushing India venture capital scene even further. Now let's look over to the how venture capital evolved in India to India perspective. So in 1988, as we already discussed, RCF, that is Risk Capital Foundation, transformed into Risk Capital and Technology Financial Corporation Limited, also known as RCTFC. This change helped focus more on technology financing and tech financing and VC fund, venture capital fund. Fast forward to 2021 and we see a huge leap. The Indian startup ecosystem attracted a whopping 17.2 billion US dollar from January to July alone, surpassing the investment made in 2020 and 2019. Now let's quickly look at some of the key features of venture capital finance. The first thing is equity based. You can see equity based. So venture capital is often provided as equity, especially when companies are not ready to float their share in the market. The next thing is support without control, right? So what does it mean, support without control? So it means that venture capitalists often offer guidance and support but don't get involved in day-to-day running of the business. And the third is exit strategy, right? So where VC usually exit when the company become profitable, earning their return through capital gain rather than interest. So this is the exit strategy. Now let's understand, we are breaking down how venture capital financing work in the next slide. How venture capital financing work. So first let's talk about how venture capitalists or VC make their money. The first is called conditional loan. So VC often earn through royalties based on companies' sale or profitability. Next is high risk, high return. VC usually invest in high risk, high reward sector like technology and biotech startup, focusing on long-term goal. Now management involvement. Sometimes VC even participate in company management to help steer it towards success. Now venture capital financing generally happen in two main stages. The first stage is called early stage, seed capital. Seed capital is the money used for research and development to test the innovative idea. Only a few funds invest here, usually through low interest rate loan. Next is the startup stage. This is when VC fund the commercial production of project, especially those with market potential like technology transfer or import substitution. So this is a quick overview of how venture capital financing work and its stages. So early stage and startup stage. These are two stages where venture capital financing is done. Now let's continue our discussion. Let's pick up from where we left off in the previous slide. Now the second round financing happen. This stage is for companies that have started production but need additional fund to keep going. It is riskier than a startup stage since the business is still proving itself, right? As you can see in the startup stage, finance for commercial production of project with market potential. Okay, so second round financing is little bit riskier. Now let's move on to the large stage financing. So expansion financing. So this is when a company needs money to grow, whether it is expanding operation, launching new product, or entering new market. The next is called bridge financing. Remember this term, very very important. This is short term funding that help a company stay afloat until a major event happen, like an IPO, right? Initial public offering or a merger. So these are like short term funding that help a company stay afloat until a major event happen. Now something called mezzanine financing, very very super important. This stage is for companies that are ready to go public, right? It provides necessary support to ensure a smooth public offering. So now let's recap. To recap the early stage financing, we have seen seed capital, which is for R&D. Remember, the recap is very important. So seed capital, R&D, which is fund for R&D to test innovative idea. Startup finance stage, finance to launch and produce commercial viable project. Second round, it is basically additional fund for company already in production but needing more capital to grow for expansion. So remember these things. These are early stage recap, second round financing, and then after later stage, in later stage, expansion financing, bridge financing, and mezzanine financing. Now so we have discussed all these things. Now let's discuss continue our journey into the world of venture capital by exploring second round and after stage financing. Second round financing is less risky and usually happen after a company has launched product. At this stage, business is starting to gain traction, so the risk for venture capitalists is lower. Now let's talk about the large later stage financing. So this include expansion financing. This is for company looking to increase its production capacity, and hence venture capitalists might retain more equity as the company grow. The last is called replacement financing. In this stage, the venture capitalists buy share from shareholder who want to exit, providing liquidity to those looking to cash out. Thus, there is something called turnaround financing. This is for reviving companies that are currently losing money. In such case, VC may appoint their own director to help steer the company back to profitability. There is something called buyout deals and management buyout. This is when active shareholder buy share from passive one, usually funding from venture capitalists. It is way for management to take control of the company. Now, let's discuss the next topic: how venture capitalist financing work and its regulation. So process. So let's start with the process of venture capital financing. There is something called deal origination. So VC find potential deal through a referral from partner, organization, or network. The next is called screening. Projects are evaluated based on factors like market potential, technology, investment size, location, and financing stage. Next is called evaluation. VC focus on entrepreneur profile, look at their skill, track record, future prospect. Deal negotiation. So after investing, VC often participate on the company board to ensure business follow the planned strategy. Deal negotiation means what? Here the terms are set, including investment amount, profit sharing, and right of both party. Now come post investment. After investing, VC often participate on the company board to ensure business follow the planned strategy. And there is something called exit plan. VC exit the investment through option like IPO, acquisition, or buyout by the original promoter, with the goal of maximizing profit and minimizing losses. Now regulatory aspect, very very important. See, so how venture capitalists are raised and finance mode especially. This is what we are going to talk about in this particular slide, which is basically relating to the regulatory aspect, right? So initially these funds were regulated by the Comptroller of Capital Issue 1998. From 1995, SEBI, Security Exchange Board of India, became responsible for registering and regulating venture capital fund. Now, SEBI 1996 regulation, which was later amended in 2000, defined venture capital fund as trust or company that have a dedicated pool of capital. These funds can only invest in venture capital undertaking, which are domestic, unlisted company, and they must avoid sectors on SEBI negative list. Now, one main thing is that venture capital fund must be registered with SEBI, right? This is very important. Must be registered with SEBI and must meet a specific condition like ensure their director and employee are fit and proper, and they can't raise money from the public. So that's the key point. Now let's discuss how venture capital fund are raised and financing modes. Let's explain all of this in the next slide. See, venture capital funds typically raise money from investor who contribute a minimum of 5 lakh each. Before starting operation, these funds must secure firm commitment totaling at least 5 crore. This ensure that they have enough capital to start investing in promising business. Now on to the modes of venture capital financing. You can see the modes of venture capital financing. Venture capital finance company through equity and debt instrument. And let's focus on equity. Equity involve ownership instrument like ordinary and preference share. Ordinary share give the investor ownership in the company but don't guarantee dividend. Let's break down preference share further. This preference share comes with an assured dividend at a specific rate. Here are the main type. You can see cumulative, non-cumulative and participative. Cumulative share accumulate until unpaid dividend, meaning if the dividend is not paid in 1 year, it carries over to the next year. Non-cumulative means they don't accumulate unpaid dividend. So if a dividend is not paid in 1 year, so it is lost. And there is participating preference share. So this share allows shareholder to receive additional dividend if the company profit exceeds a certain level. Right. So this is how venture capital fund are raised and the equity instrument they are using for. Now let's talk about the debt instrument. So debt instrument are essential tool for borrowing money, and here are the key one you should know. The first is called debenture. Debenture are long-term loan with fixed interest rate. They can be secured, that is backed by the asset, or they can be unsecured, meaning there is no collateral. Then there is something called bonds. So these bonds are similar to debenture but typically have longer maturity period, plus they are often traded on market. The next is called conditional loan. So these loans are repayable as royalties after the company start generating revenue, right? Which means repayment depends on how well the business perform. Now convertible loan. So these loans give the lender the option to convert the debt into equity at a later stage, which can be beneficial if the company value increases. Now there is a conventional loan. They are standard terms loan with fixed interest rate. They are repayable in regular installment. Now let's discuss the advantage of the venture capital financing in the final slide. So first thing is wealth and expertise. So it means VC brings not just money but also valuable expertise and network. They can help grow the business. The next thing is large equity finance. So venture capital provide a significant amount of equity financing which can be crucial for scaling up operation. The next thing is safety for entrepreneur. So unlike loan, entrepreneurs are not obligated to repay the invested amount if the business does not succeed. However, there are some disadvantages. The first thing is loss of autonomy. So founder may lose some control over their company as VC often want to say in the major decision. Complex process. See, securing venture capital is a lengthy and complex process which a high level of risk involved. Uncertain profitability. So VC make long-term investment, but the profitability is uncertain and takes years to materialize. So now let's talk about the exit route for venture capital. So VC typically aim to disinvest early to realize gain from the appreciation of their share and to fund a new venture. So here are the main exit alternative. The first thing is IPO. So the company goes public, allowing VC to sell their share on the stock market. The next is buyback. So the original promoter buy back the share from the VC, giving them an exit. So that's a wrap. Now let's summarize venture capital financing. That I think this is the last stage. Yes, merger and acquisition are there, management buyout are there, and secondary market offering are also there. So what is venture capital financing? So it is a long-term investment in business that have high growth potential. Venture capital come in various form: equity, conditional loan like royalties, and conventional loan. VC take both the financial risk and reward, betting on company future success. Venture capital financing is usually divided into two stages. I'm just recalling all the facts which we have covered earlier. The first is called early stage like seed funding, and the second is called later stage like expansion or mezzanine funding. The process is simple. Venture capital financing process typically involves 6 steps. The first step include deal orientation, screening, evaluation, negotiation, post-investment involvement, and exit plan. Exit route includes what? Exit route includes initial public offering, IPO. The company goes public. Buyback, the original promoter buy back the share and sell to another company or new VC. The VC sell their stake to another company. So that's a quick wrap up. And if you want a PDF of this particular session, you can enroll in our capsule course. The link of capsule course is provided in the description section. And friends, if you really feel this video useful to you or for your understanding, please hit the like button, please hit the bell icon, and also subscribe the channel, and also share this particular video with